Ladies and gentlemen, good day and welcome to Datamatics Global Services Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prateek Jagtap from EY Investor Relations. Thank you, and over to you, sir.
Thank you, Aman. Good afternoon to all participants in the call today. Welcome to the Q4 and full year FY23 earnings call of Datamatics Global Services Limited. The results and presentation have been already mailed to you, and it is also available on the website of the Datamatics. In case anyone has not received the copy of press release and presentation, please do write to us and we will be happy to send you all. To take us through the results today and to answer your questions, we have with us the top management of the company, represented by Rahul Kanodia, Vice Chairman and CEO, Sandeep Mantri, EVP and Chief Financial Officer, and Mitul Mehta, EVP and Chief Marketing Officer. Rahul will start the call with brief overview of the quarter on business, which will be then followed by Sandeep talking on financials. We will then open the floor for question and answer session. I would like to remind you that anything that's said on this call, which gives any outlook for the future, which can be construed as forward-looking statement, must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual reports, which you can find on our website. With that said, I now hand over the call to Rahul sir. Over to you, sir.
Thank you, Prateek, and a very warm welcome, and thank you everyone for joining our Q4 FY23 earnings call. We are glad to have you on the call today. I am extremely pleased with the overall performance of the business during the year. This was the first quarter in which we surpassed the 400 crore revenue mark. This revenue growth was broad-based, driven by all three segments of digital operations, digital experiences, and digital technologies. Despite the global economic situation, we managed to maintain a healthy margin throughout the year. We had a strong EBITDA growth of 25.5% with an EBITDA margin of 16.6% for financial year 23. I will briefly touch upon each of our segments and their performance. The digital technologies, our EBIT margin saw a considerable improvement from 2.2% to 9.1% in Q4 of financial year 23, primarily due to renegotiated prices and tighter cost controls. Going forward, we are actively focusing on hyperscalers and deepening our client relationship as our growth strategy. Our deal pipeline for the next year remains strong. In digital operations, we witnessed strong growth on the top line, and our EBIT margin improved from 19.5% to 23% on a sequential quarter basis. Traditionally, our Q4 tends to be better than Q3 due to the cyclicality of some of our projects, which requires us to ramp up headcount in Q3 and execute in Q4. In digital experiences, though our top line saw a slight decline in Q4, EBIT margins continued to be strong at 28.2%. We have a healthy pipeline and our business will grow on the back of new customer acquisition. Going forward, we anticipate that these operations will continue to generate strong margins in the same range as this year. We are seeing supply side challenges easing off, which would help us in optimizing our costs for the next financial year. In Q4 of 23, we signed a total contract of about 20 million and added about 21 new customers. In line with the account growth, our capabilities and strengths demonstrated to our existing clients have resulted in several deal wins which remain strong for the quarter. I am happy to share that we have recommended a total dividend of 100%, which is 5 rupees per share. On a concluding note, I'd like to add that while there is some amount of slowdown across the globe due to macroeconomic factors, we do not see a material impact on the deal wins or existing client spend. We expect to see a sustained growth momentum for financial year 23-24, given a decent pipeline of opportunities. This makes us optimistic about our overall demand and confident of maintaining an overall revenue growth of 14 to 15% in financial year 24. With that, I will now hand over the call to our CFO, Sandeep Mantri. Sandeep, over to you.
Thank you, Rahul. Welcome everyone, and thank you for joining us in Q4 and full year earnings call. Let me start with the financial performance for Q4 FY23, and then I will take you through the FY23 numbers. Our Q4 FY23 revenue stood at rupees 416.3 crores, which is up by 11.7% on a sequential basis and 32.9% on a YOY basis. As Rahul highlighted, this was a milestone quarter for us as we exceeded the revenue mark of 400 crores for the first time ever in a single quarter, and was ably supported by all the three segments. Our consolidated EBITDA for the quarter was at rupees 84.1 crore, which is up by 42.7% on a sequential basis and 63.5% on a YOY basis. Our cost optimization strategy, coupled with other initiatives, helped us maintain a double-digit healthy EBITDA margin of 20.2%. Our consolidated EBIT for the quarter was at 75.3 crores, reflecting tremendous growth of 50% on sequential basis and 78% on a YOY basis. EBIT margin for the quarter was at 18.1%. Our other income on a consolidated basis stood at rupees 5.3 crores, which is a decline of 50% sequentially and 56% on a YOY basis. Primary reason for decline is the exchange gains, which was not there in this quarter. Our quarterly PAT after NCI was at 59.7 crores, which is a growth of 30.2% on a sequential basis and 30.9% on a YOY basis. Our tax rate for this quarter was at 27% compared to 25.3% in the last quarter, which is quarter 3 FY23. Our EPS for this quarter is at 10 rupees 13 paisa per share, which is higher than the last year same period, which was at 7.73 per share. When we see segment-wise revenue performance, digital operations revenue was at 187.3 crores, which is a growth of 22.6% on a sequential basis and 31.6% on YOY basis. Operations EBIT margin was at 23%. Its contribution to total revenue was 45%. Our digital experience revenue was at 59.5 crore, which is a slight decline of 2.7% on a sequential basis, and there was a growth of 48.8% on a YOY basis. Its EBIT margin was at 28.2%, and its contribution to total revenue is 14%. Our digital technology revenue was at 169.5 crore, which is a growth of 6.8% on a sequential basis and 29.4% on a YOY basis. EBIT margin is 2 to 9.1%. Although the margins were negative in the first two quarters of FY23, this segment has performed very well, and we will see continuous improvement in the margin trajectory of digital technology segment. Its contribution to total revenue was 41%. Now, coming to annual numbers, FY23 financials, our full year revenue was at 1459.2 crore, which is a growth of 21.5%. Our EBITDA was at 242.6 crore, which is again up by 25.5% as compared to last year. EBITDA margin stood at 16.6% on an annual basis, and we aspire to maintain the similar kind of margin next year as well. Our EBIT was at rupees 207.6 crore, which is a growth of 29.8% on YOY basis, and with margin stood at 14.2%. Our other income for the year was at 38.7 crore, which is a growth of 47% on a YOY basis, primarily due to exchange gains, SEIS incentive, and better investment income. Our PBT before exceptional item was at 243.4 crore, which is a growth of 32.7%. Our PAT after NCI was at 189 crore, which is a growth of 20% on a YOY basis. Tax rate for the year was at 23.9%, which is slightly higher than our earlier expectation of 23%. Our EPS for the full year was at 32.05 per share as compared to 26.71 per share in the last year, a growth of 20% on a YOY basis. If you see our segment-wise revenue mix for FY23, Digital operations revenue was at 630.7 crore, which is up by 21.9%, and EBIT margin for the digital operation was at 22.2% on an annual basis. Our digital experience revenue was at 219.3 crore, which is up by 38.8%, and margin was at 26.4%. Our digital technologies revenue was at 609.1 crore, up by 15.9%, and EBIT margin for the full year was at 1.6%. We continue to maintain a healthy balance sheet. As on March 31st, 2023, our total cash and investment, net of debt, zero debt, basically we are a zero debt company, stood at 498.2 crore. Our DSO was at 67 days for the full year as compared to 74 days as on March 31st, 2022. In terms of geographical footprint, US remains our largest geography with 54% of our business coming from here, followed by India at 27%. Rest of the world, including UK and Europe, at 19%. In terms of industry footprint, BFSI continues to remain the largest segment of us, which include 24% of our revenue, followed by education and publishing, which is 22%, then technology and consulting at 19%, non-profit or non-government organization at 12%, manufacturing, infra and logistics at 12%, retail at 8% of our business, and other segments are 3% of our total revenue. Our client concentration remains very healthy, with top 5, 10, and 20 clients contributing to 24%, 37%, and 52% respectively. The board has recommended a total dividend of rupees 5, which includes 3.75 as final dividend and 1.25 as a special dividend per share for the year ended March 31, 2022-23. With this, I will now pass on the call to operator to open the floor for questions. Thank you for your continued interest in Datamatics. Thank you. Operator, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pallavi Deshpande from Samiksha Capital. Please go ahead.
Yes, sir. Congratulations on a very good quarter. Just wanted to understand on the digital technology side, what's driving the turnaround and what would be the, strategy going ahead. Like I think you mentioned about, the margins also being sustained. So did we see some new client additions?
Yeah, so we are looking at new client addition quite significantly. Our margins improved because of better negotiation, as I mentioned, and also tighter cost control. Going forward, we will be focusing on hyperscalers, which are things like, Microsoft Power Apps, AI, cloud, those analytics, all of those areas. And we're beginning to get some very good traction on that, and plus deepening our client relationships. So these will be the main drivers for growth. Our focus on the US continues, and that's also getting us some very good traction. In terms of margin stability, I think the margins will be stable. We may have a dip this quarter because of the increments. Every company goes through the increment cycle around April. So in this first quarter, we'll have a dip, but it will normalize through the course of the year. So I think we should have a fairly healthy margin going forward.
Right. So we had a lot of volatility in margins that we saw in quarters in FY23. So we see stability, and do we see, stability at what levels, around what level?
Can you repeat that question?
We saw a lot of volatility in the quarters in FY23 for this division, I think, because of a large client drop-off also.
That's correct.
Right. So the stability we'll see is with respect to 4Q margins. Are we referring to that, or, what is the normalized?
Will be there. So the client that shrunk has now stabilized. In fact, is marginally grown. So I don't see an issue on that front. Plus, we have got a very healthy pipeline with good margins coming in. As I said, we negotiated prices, so we should be okay. Having said that, of course, we see in the market a little bit of an issue with the BFSI segment, particularly in the US. Having said that, so we think there'll be a little bit of softness in the BFSI, but our pipeline is healthy and our pipeline is good. So I'm not concerned from a Datamatics point of view, but yes, at the industry level, you may see a little bit of a slowdown, particularly in BFSI. But as far as Datamatics is concerned, I don't see that impacting us majorly.
Right. Yeah, I mean, that's good to know because the BFSI is a weak spot. But also on the UI part or whatever, we've seen those companies actually also stop burning cash, I guess. So is that also improving the environment, this tightness and liquidity? I mean, what's driving overall the environment for the space, US?
Sorry, I'm not very clear. Your line is not very clear, and also the question is not really clear. If you could repeat it.
I just wanted to understand the space, right, in this in the IPA space, RPA space, UiPath reported numbers which showed, that the burn rate is coming down for them. The losses were down. So does that indicate to you, more sanity in the marketplace in this space, in the RPA space particularly?
Yeah, so yeah, you're right. So there is some sanity coming in. Valuations have become more realistic than what they used to be. I think these companies have stopped burning the way they were. They were, I think, unnecessarily burning. We are getting fairly good traction. Our deal sizes are increasing. The customer acquisition rate has gone up. So I think we are well positioned. As far as UiPath is concerned, we are also getting some customers moving out of UiPath and switching over to our TrueBot products. But overall, we are getting some very good traction in that space. Right. And the analyst coverage for our products has been extremely good. The customer feedback also has been very, very healthy.
And in terms of the price negotiation you mentioned, what would be the kind of price uptick you've seen in there?
So through the course of last year, at varying points, we did negotiate with several customers, and we were able to raise prices anywhere from 5% to 30%. Of course, each customer, each project was very different, and that should go through for this year as well, because we had already renegotiated. So last year, because it happened through the course of the year, you did not see the full impact. This year, you will see the full impact, and of course, we continue to talk to many of our customers for revised prices. Fortunately, what's happening is that the Western world, America and Europe in particular, are going through huge inflation. So their cost structures are going up, and because of that, they recognize that they may need to pay higher because their own cost structures are going up. So we are finding it a little easier in negotiating prices with customers.
And so lastly, on the acquisition side, if you could update us, how I'm looking at that now. And how close are we to completing or doing a deal here?
No, so we are in dialogue. We have initiated dialogue with several customers or prospects, target companies. We are looking at making acquisitions somewhere in the range of $20 to $50 million this year. Having said that, we are not just going to buy a company for the sake of buying a company, so the due diligence has to be fairly thorough, and then it has to fit our strategy. It has to fit into our customer acquisition and deepening our expertise. So in that sense, we are looking for good fits. Fortunately, we are in dialogue with some companies, and I am very hopeful that in this financial year, we should be able to close some deals.
And this would be in the digital technologies piece, or?
That is correct. That is correct.
Mm-hmm. I'll come back in the queue for further questions. Thank you so much.
Thank you. The next question is on the line of Pratap Malewal from Mount Intra Finance. Please go ahead.
Hi, am I audible, please?
Yes.
Okay. Hi, and thanks for taking my question. Congrats on a good set of numbers. So last quarter, we had said that we've taken some price hikes, that we've renegotiated certain deals with customers, and that some of that effect will come in the next quarter, that is the Q4. So I just wanted to ask, we've got strong growth of about 11.7%. What portion of this growth was due to the price hikes, and what portion maybe was due to the ramp-up of deals won during the year?
I don't have that breakup. Some of it is not easy to get because some of it would be an increase in business from customers for whom we've hiked our prices. So it's a combination of both volume increase as well as price hike. Some of them are new customers. So I don't have the breakup, but that number may not be the easiest one to calculate.
Okay, understood. Now, last quarter we had given a guidance that we'll get about 15% growth for FY24. And now, despite such a strong quarter in Q4, we've kind of given a range of 14 to 15%. So just trying to understand, are we baking in some kind of conservatism in our outlook for FY24, or has something changed materially in the demand outlook? Could you just give us some clarity on that?
Yeah, so there's no impact on the demand outlook. That remains equally robust. But one is seeing some softness in the US BFSI sector, and one is seeing some headwinds, particularly out of US and Europe. Many other companies are predicting slower growth. So we think that there could be some softness. However, as far as Datamatics is concerned, we are still seeing a very healthy pipeline, so I don't see that as an issue. But we are being a bit cautious because you don't know which way the world will go in the next 12 months because of these economic challenges that they're having, inflation and recession and things like that.
Okay, and you just called out that the deal wins for the quarter was about 20 million. Did I hear that correct?
That's correct.
And this is in range with our normal range, or what is the normal range of deal wins that we usually get?
Yeah, it typically ranges about 15 odd million, 15, 17 million. So 20 million is in range with our regular thing.
And we expect this to carry on even in FY24.
Yeah, we expect, as on today, where we stand, we expect that trend to continue.
Okay, sir. Thank you. Thanks for taking my questions, and congrats on a good set of numbers.
Thank you. Thank you.
Yeah.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Akshat Mehta from Samiksha Capital. Please go ahead.
Hello, am I audible?
Yes, sir.
Audible,
Please
but a
use the
little
handset.
unclear.
Yes, please use the handset, Akshat.
Hi, congratulations on good quarter, and thank you for the opportunity. I have a couple of questions here. What is the kind of, you said that this quarter we will be taking some hikes in terms of employee costs. So what is the kind of hike that we are planning? If you can share some, light on that.
Sorry, can you repeat the question? Increments. Yeah, the increments would overall range approximately averaging about 10.5%. But obviously, it's not the same for everyone. Some high performers will be getting higher, some low performers will be lower. There's a churn. So yeah, overall average approximately 10.5%.
Okay.
So you will see an impact in Q1 because obviously the increments come in now, but it will normalize over the course of the year.
Okay. Secondly, out of which area, out of the three, segments that we have, operations, experience, and technology, and obviously there are different solutions that you provide in that. Which areas are we seeing, the most growth coming out of at the moment?
Right now, we're getting a fairly even growth across the board. If you see, our growth was highest in the digital experiences last year. But this year, we're looking at a fairly balanced growth across all these three segments.
Okay. Okay, thank you. I'll come back.
Thank you.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir, and thank you so much for taking my question. I hope I'm audible.
Yes.
Yeah, so congratulations on a great set of results. So I just wanted to ask, so we are planning for a 14-15% growth, but our margins, we are probably looking at the same range that we did this year. But will we also have some kind of operating leverage that could, drive our margins even higher?
Yeah, we are looking at some of those operating benefits and leverage, and we should be able to improve margins a little bit, for sure. I think on an overall basis, we could be looking at plus or minus about 1%. So that could happen as we go through the course of the year. Both through operational efficiencies, price negotiations, tightening the belt. So there'll be a multitude of factors that will contribute to it. But you're right. So there should be some improvement in margins as well.
Correct, sir. And sir, our inorganic acquisition that we are looking at, so that would also give us a higher revenue than our 14-15%. So our 14-15 would be our organic revenue, and whatever we get from our new acquisition would be another. Correct, sir? Is my understanding correct?
Yes, that is correct.
Correct. Okay, sir. So, around what kind of, range are we looking the acquisition at, in terms of which segment or when could we close, or could you just give some more details about the acquisition that we are planning?
So we are looking at acquisitions in the hyperscaler areas, which I mentioned earlier, around Microsoft Power Apps, Salesforce, Cloud, those kinds of technology areas. We're looking at companies in the range of 20 to 50 million. It could be one acquisition, or it could be 2 or 3 smaller ones. That is unclear as we go through the process of discussing with target companies and negotiating with them. So it's not quite clear which way it'll go, but yeah, it's somewhere in that range.
Okay, sir. And any sort of timeline, like we could see it in the second half of the year, nothing concrete, but just a small range that could help.
That is correct. Nothing so concrete. Therefore, I don't expect anything significant in this quarter or the first quarter. But depending on how the negotiations mature, there could be something in Q2 or Q3.
Okay, sir. And sir, any other risk that you could see, that we could face, or we are on a stable pipeline of growth?
No, I think we are on a fairly stable pipeline. I don't, at this point, see any risks.
Okay.
Takes over Taiwan.
Correct, sir. Thank you so much for answering my question. All the best, sir. Looking forward to great numbers, sir.
Thank you.
Yeah.
Thank you. The next question is on the line of Pranav Mashruwala from Dolat Capital. Please go ahead.
Hello. Yeah, hi. Can you hear me?
Go ahead. Yes, we can hear you.
Yeah. I just wanted to ask about your India plans. So India is about 27% of your revenue. And how do you see growth panning out for India and contributing to our FY24 guide?
So India has traditionally grown very well for us. However, India tends to be a little lower margin. It's a very price-sensitive market. So our focus is now increasingly focusing on the US and Europe. So that's really where we do. So in that sense, in a proportionate ratio, India might slow down. Although India in itself is growing and it will grow very healthy, but we will put more effort on the US and Europe. So therefore, proportionately, India will be a little lower.
And BFSI segment, any particular specific pockets of areas where you see slowdown to be more acute?
Not in particular. We're not seeing. We see a fairly healthy pipeline. But yes, many of our customers who are in that segment are a little nervous right now. So it's possible that some of them start tightening the purse strings. But right now, we don't see that happening. On the ground, in terms of my current deal pipeline and deal flow, I don't see that. But given the situation in the US, it's possible that some of them could slow down a little bit. So we are being cautious, but we are still optimistic because we don't see an impact on our pipeline.
Finally, on the education learning segment, how do you see the outlook in this segment?
So bulk of our business is more in that segment is mostly in the traditional education space, more and not in the edtech. The edtech has been impacted quite significantly. So I don't see an impact on Datamatics because the larger part of our business is in the traditional education space.
Okay. Thank you.
Thank you.
Thank you. Our next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Hello.
Hello.
Yeah, am I audible?
Yes.
Yes, Arpit. Slightly muffled. Request you to be a little closer to the mic. Thank you.
Yes. Just wanted to understand if there were any one-offs in revenues this quarter, at least in digital operations, because you had a very high sequential growth of around 20% or so. Just wanted to understand if there was any one-off in digital operations.
No. There was no one-off deal. we do tend to have a little higher quarter in Q4, typically compared to Q3. That's been a traditional cycle that you see in Datamatics. So I think it's that, and this quarter probably is stronger, but yes, there's no one of these that has caused a spike.
Got it. Yeah, and just wanted to understand, are we seeing any kind of J curve in digital technologies margins? Because we've probably moved from -4%, -2% to now 9%. And are you seeing double-digit kind of margin in this business, or how does it look like going ahead?
Yeah. So if you're asking whether the 9% will go into double digits of maybe 12, 13, 14, 15%.
Yes.
So that will happen as we improve our operations and as the price renegotiation has a full impact. So it should improve, but I don't have a figure to exactly where it will end up for the year. But yes, it should improve in principle. Obviously, quarter to quarter there will be some fluctuation, as I mentioned earlier. Q1 it might go down a little bit because of the increments, but then it will normalize through the course of the year. So conceptually it should improve a couple of percentage points.
Got it. And does the products business sit under digital technologies products business?
That is correct. It does.
Okay. And even the AFC contracts which you all had signed a couple of quarters back, that sits in digital technologies.
That is also correct.
So is that ramping up very fast for you? Is that the reason the margins are in line?
Ramping up well. We've got several prospects that we are talking to, but these are very tender-driven projects, and they are semi-government in nature, so they take time to materialize. And they're chunky deals. So when they materialize, suddenly you get a $20, $30, $40 million deal. But yes, they do sit into digital technologies, and we are in active dialogue with several prospects, but nothing will close in the next, perhaps towards the end of this quarter, maybe early next quarter, we might have something happening.
Got it. Even in the third quarter of FY22, we had seen a margins of around 8% on digital technologies. And after 4 or 5 quarters, we've moved again to 9%. So do you see any risk that this number would move back to, let's say, lower single digits?
No, I don't see that at this point in time. There's a slide. We had a slide largely because of our large customer had chosen a multi-vendor strategy, and therefore it was a large chunk that moved out, which of course, and also what happened last year is that the whole IT industry went through a crazy phase of huge salary hikes. So there is a combination of salary hikes plus the squeezing from some customers was the result. I don't expect that to happen now. We are already seeing a supply side easing off. So I think we should be okay.
Got it. And we saw about 11 to 12% of sequential revenue growth from Q4 to Q3. So why are we guiding for 14 to 15% kind of growth rates? Is it just trying to be conservative, or do you have any ramp downs or any different kind of revenue adjustments that you have to make, or what is it? Why is this 14, 15% revenue?
No, we don't have any ramp downs. So we are just being a little cautious, given the situation in the US is a little uncertain and a little volatile, particularly the BFSI segment. So we are being cautious. So far, as far as our deal pipeline is concerned, we don't see an impact. But but we don't know which way the wind will go in the US.
And the 20% margin which we have done this quarter, would that continue, or will come back to 16 to 17% kind of number which we did for FY23?
No, it will come back. A 20% quarter is not going to sustain at that level. It will come down a little bit.
So on an annual basis, we had 16.6%, and I think for the next year also, we should be in the same range between 16 to 17.5%.
Okay. Thank you so much.
Thank you. Any participants who would like to ask a question at this time, they may please press star and 1. The next question is a follow-up question from the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
Yes, on the digital technology side, if you could just share, I think total client additions were 21 for the organization. So how many would have been on the digital technology side?
In the quarter? Okay, I don't have that number for you.
For the year.
For the year?
21 was for the quarter, right? Either for the quarter or the year.
So we are running at we had 79 for the year, so roughly 20 per quarter. a good chunk of them are coming from the digital technology side. But I don't have that breakup handy with me right now.
Right.
But suffice it to say, it would be about 40%, 40 to 50%.
Yeah. Right. And on this, what would be the share of implementation work that we do on the digital technology side?
I don't have that breakup either. How much implementation versus software support, maintenance, development?
I don't think that
we don't take that up actually.
We don't do that.
Right. And on the educational learning side, would that be lower margin than the overall margin side?
No. That's a fairly healthy margins.
Right.
So,
And this what would be the employee hiring plans for FY24?
So increasingly we are going more on platforms and technology rather than headcount. So we'll see a disproportionate increase in revenue versus employee headcount. But this year we would have added approximately 1,200 employees at net increase. Next year, I think we should be in the range of about, depending on the growth rate, of course, at about maybe 1,400 employees.
Now, assuming a growth rate of 15% on the revenues, that would be 1,400.
That is correct. But our employee headcount may not increase in line with the revenue increase.
Right. And lastly, on this, on the India business and this automatic fare system, what percentage of share would that be of the India business at ESS?
Can you repeat that question? Your line is not clear.
The automatic fare systems which you have, and what would be the share of that in the India revenue? Would it be a major chunk of the India revenue?
So our India revenue is about
in AFC.
Yeah. So just give me a second. So 100 into 0.27. So it's about a fourth of India. 25% of India comes from the AFC.
Right. And I just didn't get that part. So I think you mentioned that lumpy and we expect wins there in the second and third quarter. Is that right?
So these projects tend to be lumpy and chunky because when they come, then it's a large deal. Otherwise, it doesn't come for a while. So it's not that every month or 2 months you're signing new deals. And therefore, the next deal, and because it's very tender driven, it depends on certain guidelines and timelines given by the government, and therefore it's very hard to predict. But yes, I do expect sometime around the end of Q1 or early Q2, we should have potentially something maturing. But of course, that depends also whether we win the deal or not. So, so that's when we expect to hopefully sign the next deal.
Right. And in terms of businesses, like, we're hearing a lot about the low code, no code. How is, how do you see that driving growth in new areas of
So we are implementing it. For us, it's going quite well. We are implementing several projects using low code, no code. So therefore, we're generating more and more business on those platforms. And the margins also fairly healthy. So we're quite optimistic on pushing the low-code, no-code solutions into the market. We are beginning to see some internal productivity benefit gains as well, but they are still in a little bit of a pilot phase internally. Right.
And in terms of the other business was this application modernization, how is that progress?
So that's done well, and low-code, no-code is part of that application modernization.
Right. Okay. Right. Yeah. And on the lastly on the investments in the product space, I think you mentioned in the last call that we're nearly done with that. So it's only on the marketing side that you need to ramp up that.
Yes.
So what would be what would be the kind of spend, or can that also be a drain on margins in the near term?
I think I mentioned in the previous quarter calls that we are spending about 40 to 50 crores rupees in that spend. We will sustain that for now, and as we spend more on the marketing, and the growth will happen. So the growth and the marketing increase will kind of offset each other, but we will sustain the spend at about 40 to 50 crores.
Right. Okay. Thank you so much.
Thank you.
Thank you.